we're turning to a leader of the Australian banking industry. David Murray was inaugural chairman of the Australian Government Future Fund, for 13 years the chief executive of the Commonwealth Bank, and recently chaired an inquiry into the financial system inquiry. So please welcome David Murray.
Well, thank you for that introduction, and thanks for talking about the abattoir. In Hunters Hill, we've got some radioactive waste from industrial development, and no one will take it. So we're still struggling with it, but we're not struggling in Hunters Hill, I'm pleased to say. Let me start with a quote, when I get organised, of a study that was done and released only in 2010 by some professors at Harvard after a global study, and they said there's a series of publicly valued goods and services that the market system requires for it to function properly. This book was about market capitalism, but democratic governments seem unable to buy or produce them. The goods in question included a number of things, including a variety of forms of infrastructure. I think that sets the tone as to what's happened globally about government finances. And in the post-GFC world, the issue for us is that public funds are constrained, which I'll talk about. So how do we get the benefits of new infrastructure at no or little net cost to government? And I'll explain why government is constrained in the way they are. To do that, I'd like to talk about productivity and infrastructure, non-government investment and project design. So let me start then with productivity and infrastructure. The global financial crisis happened because there was a huge build-up over many, many years of easy monetary policy and easy fiscal policy around the world, but particularly in the United States and Europe. The consequence of this build-up was that there was terrific momentum in asset prices in financial markets, and it seemed possible to leverage anything and succeed. And the excesses that this created built up a head of steam for a contraction that was always going to be very serious. The first response of government, even though they had got themselves into significant levels of debt, was to have to bail out the system by taking liabilities from the system and putting them back on the government balance sheet. In turn, governments entered into periods of substantial stimulus to try and stave off a deflationary problem. Later on, governments went further with quantitative easing, again because the central banks were concerned about deflation. And the reason they did that was that there's no precedent for taking interest rates below zero. So these things had quite significant consequences. The first consequence is that we will have a very extended period of low growth. In the period up to 2007, in the 100 years up to 2007, there had been two periods in the world, each of 20 years long, where the world had almost no growth. And you would expect, after a crisis like this one, that we will do the same again. The reason for this is that when governments overstimulate with easy fiscal policy, they are in fact borrowing growth from the future for the present. And that means we have to repay that growth. It's very hard to get high growth after that period. The other consequence is that by using quantitative easing in particular, governments are taking savings from private savers in the world and giving those savings back to themselves. How did we see this manifested? We saw low returns on investment post-crisis for superannuation funds and individuals generally, where it still applies. But we're seeing lower cost to government in the form of very low bond yields. And the other effect that we saw was the distortions around the world, particularly in currencies. So for Australia, where we might normally respond for an extended period with a lower currency, we were fighting off the problem of an overvalued currency with the two-speed effect that that was having on our economy, in common with New Zealand, Korea, Brazil and other countries like us. So this has made the post-crisis period very difficult to work through. You might have noticed in this time a lot of talk about productivity. The reason for that is that when there's a natural constraint to growth, when fiscal stimulus is no longer available, the obvious thing to do is to make structural reforms to improve productivity, because it is, in economic terms, frankly, the only free lunch. But of course, those productivity improvements come with them quite some criticism. Why do we have to have austerity? Doesn't productivity mean loss of jobs, and so forth? And this has made it harder for democratic governments to implement serious structural reform, even though in certain places, particularly in Europe, it is desperately needed. So quite some time on from the crisis, we have rising government debt, no serious start on structural reform, but still the lingering effects of the crisis with us. That reminds me about the gentleman who was visiting Greece, and he arrived at the immigration point, and the immigration officer said to him, nationality, and this gentleman said, German. And the immigration officer then said to him, occupation, and the German gentleman said, no, 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 just visiting. So with this reluctance for serious reform, we have with us an issue which is hard to solve. And that is, infrastructure is by itself a serious reform item, a serious productivity item. Infrastructure creates pooling and spillover benefits not available in most other investments. But the conundrum with infrastructure is that the best place entity to undertake infrastructure investment is government. The reason for that is that the rate of return to government from infrastructure is higher than anybody in the private sector. And in turn, there are two reasons for this. First, their cost of funds are lower. And second, the externalities available to government through spillover effects and risk pooling mean that they need a lower premium to undertake infrastructure project than the private sector would want, for good reasons. So if infrastructure is fantastic for productivity improvement, the government is constrained fiscally so it means that the benefits are dependent on the private sector. Can I just say, in terms of governments being constrained, the credit rating of the Commonwealth Government is dependent on its level of debt relative to GDP, but not just its own debt, the level of debt of the Commonwealth Government and the states combined, because the Commonwealth is the backstop for the states. And the rating agency set a limit on that debt relative to GDP. This means that the state level of debt does matter in the scheme of things, because, at least theoretically, a rogue state or states in Australia that accumulate too much debt, will be damaging not only their own credit rating, but the credit rating of the Commonwealth and potentially the credit rating of the other states. So the states have an interest in collaboration in the quality of their financial management. So, as I said, the benefits of infrastructure, if we need infrastructure to help with productivity improvement, are dependent on private sector investment. In my time at the Future Fund, we adopted what we called a dynamic asset allocation process. That is, we didn't just decide on 70% equities and 30% bonds, lock it in, leave it there and hope we meet the target in a long time. We looked at a range of instruments, a range of investments that would meet our target of 5% over inflation on the basis that as we saw conditions change, we could adjust those portfolios. What was curious to me in going through that, firstly, was the amazing benefit of infrastructure in a long-term fund and the interest that other sovereign wealth funds in the world had gathered in infrastructure investment. So let me just talk first about why. For the right infrastructure investment over the long term, the infrastructure investment in a investment fund, a long-term fund, matches a long-term liability structure. The second issue is that for the right type of infrastructure late in its life, it starts to spin off a whole lot of cash, which takes liquidity pressure off the fund, and particularly with an ageing population, helps to meet the future liabilities for pensions of that fund. But the more interesting thing was my friends in the other sovereign wealth funds who had figured out that post-crisis we were entering into a low return world for a long time. And particularly their concern about government bonds, sovereign bonds around the world. When the sovereign bond yield went under 2%, they could see that there would be a time when interest rates would rise and they could well be in the very worst position possible. So what they were looking for was how to take sovereign risk without buying sovereign bonds. And they turned their attention to high-quality essential services infrastructure in which there was a quasi-sovereign risk but a better rate of return than sovereign bonds. And this is what's been accelerating the interest in infrastructure from sovereign wealth funds and pension funds, which are the largest investors in the world. In terms of the assets themselves, investors will of course look at the rate of return. They'll look at sovereign risk, they'll look at the duration of the asset, but they will have certain expectations for sovereign risk in the way a project is structured, and they will rank them according to country allocations, the quality of the partners they're involved with, and their own knowledge about particular projects. So the role of government shifts if the expectation is that we need to use private sector investment. In doing this, governments have got to move to as transparent a position as possible on the way they undertake projects so that they can give comfort to private sector investors that they will be treated fairly. They need to be explicit about the risk sharing that they are and are not prepared to take on. And they need to be clear about the way the law works with zoning and planning so that there's no confusion about the quality of an asset. In particular, if a government is to adopt a policy of recycling assets, they can create a better advantage for investors by selling proven up brownfield investments, and on top of that, they need to establish with investors what track record of risk sharing they're going to take with greenfield investments. For example, if a government wants to take patronage risk on a new investment and sell that later, or to take construction risk or to take risk of some other sort, it needs to be clear what that is going to be. I should say in that respect that the approach of recycling assets is absolutely clear when governments are constrained, an absolutely clear policy, and the more of that can be done, the more the government can divert part of its expenditures to the projects which government is best at in terms of 100% funding by government, and after that the more it can turn its attention to part financing and recycling of other investments, and it can leave some, of course, entirely to the private sector. So this is a way of maximising productivity by maximising the project uptake in an otherwise difficult time for economic growth. So I would conclude by saying there that there is no shortage of funds available for the right project for a sovereign government in whom investors have got confidence and where the structuring is done very, very well. So turning to design, and using the Bays Precinct purely as an example, if a project is one in which the 100% financing by government is not obvious, then the viability of the project will go to achieving the highest value land use possible, and giving priority to that project. Now, to the extent that taxes, levies and whatever is charged on that project are necessary, it's important to remember that those taxes, tolls, taxes, levies, whatever, actually reduce the overall return to the community. They change the time frame of the investment, but they reduce the return. And they reduce that return net of bond interest that the government would otherwise have had to pay. So it's important, by adding value to land use, that governments attempt to minimise the on-costs for that project when it's completed. Put another way, if infrastructure investment is to be successful, it has to have the effect of reducing costs to the community. Costs in terms of road transport, rail transport, time to get to work, time to work, logistics for suppliers, for business, and so on. The next way to add value, apart from the land itself, is to exploit pockets of demand. So again, using the Bays project as an example, the Bays project seems to me, and I'm not an expert, as the new North Sydney in the inner west. And we can learn a lot of lessons from the value that North Sydney has added to the central business district, the value that it's added to the northern part of Sydney and parts of the Neutral Bay area. So that's one important thing, but there are other pockets of demand. For example, it's likely that we will have trouble keeping up with demand for tourism from Asia and particularly from China. And a precinct such as this could play a significant additional role in tourism. Having worked on this financial system inquiry for nearly a year, I can tell you that the possibilities in the digital world and IT are endless. But it will change the shape of the way people live. It will combine home space and workspace in different ways. It will combine residential space and commercial space in different ways. And this will by changing the way people work, will open up the possibility of urban development that in fact also does a lot of service work in the economy. A very good example of this is the area of North Sydney, which sits immediately to the west of Milsons Point Station. If you look there, the amount of activity that combines residential and commercial and office, it's quite an interesting mix. In terms of the synergies in the surrounding environment, I mentioned the proximity, but in adding value to land, again, taking the Bays Precinct, why is it not possible either to reclaim some of the waterway and use that for transport thoroughfare, to use it for higher value land, or why is it not, for example, possible to extend the waterway into parts of that precinct to make for different water transport possibilities, to add value to urban residential living? Why can't we reopen the Glebe Island Bridge? Why can't we put a tunnel under the old Glebe Island Bridge? Why can't we make it a toll bridge? Why can't we use that transit way to create another avenue of transport of any sort in and out of that precinct? The government needs schools and hospitals in the inner west. Can those requirements be piggybacked in some way on the precinct? The more I thought about it, the more the possibilities, but what struck me is that where you're working in an infrastructure investment where there's a large residential component, the reality is that individuals end up owning a lot of that property. So the financing is different. In that respect, it's not going to be one that falls into that first category that the government should fund 100% itself. And therefore, to get synergies and using networks in the way this precinct works, together with adding value to the land, will be key to making it viable. And I'm reminded with networks of what the economists call Metcalfe's law, which is that the value of a network is the square of the sum of the nodes. It's extraordinarily powerful. So the more that the Bays Precinct sits within a valuable network, the more valuable it will be to the whole of the network. So the point is, I guess, that it's in the design where most of the value add will lie, and that's where most effort should go in early on, because that will make a difference to investors. I was grateful to a visiting economist, Woody Brock, who came here many years ago, back in 2010, and he said that that from the viewpoint of the bondholders, people who finance governments can do three things. They can smooth or subsidise consumption, that is, to smooth the growth rate in the economy, or they can build infrastructure to nowhere, which is another name for pork barrelling, or they can build infrastructure to somewhere, which gets the network benefit. And the critical point that Woody made was investors only look favourably on the third one. But the reason they do, and the reason it's important, is that bondholders will adjust their view of the forward debt and deficits of government for the value of good projects. Instead of treating them as a one-off cost, they will amortise them over time because they know they're valuable. This means that great projects give governments even more breathing space in dealing with debt and deficit in the sort of situation we have post-crisis. So the quality of the project, the quality of the government, and the way in which this sovereign risk is managed all make a huge difference to succeeding in growing out of the sort of issue that we're confronted with. So I think the imperatives for urban land transformation then are that there be no net government development costs, that is neutral project funding, that they should add very significant value to existing private and public land holdings, and that they should complement the surrounding built environment. Thanks very much.